What would be the applicable IFRS to comply with when we now prepare consolidated financial statements? There are quite a few IFRS that prescribes accounting treatment of different forms of business combinations and consolidated financial statements. The focus for now is on the following three. IAS 27 that looks at the separate financial statements and specifically the separate financial statements of the parent, and the accounting treatment of the investment in subsidiary that is accounted for in the separate financial statements of the parent. Please make sure that you can distinguish between the separate financial statements of the parent and the subsidiary versus the consolidated financial statements. The separate financial statements is the starting point when we consolidate, but it's two separate sets of complete financial statements. So IAS 27 would not have any prescribed accounting treatment for purposes of the consolidated financial statements. For that, we'll look at IFRS 3 business combinations and IFRS 10 consolidated financial statements. IFRS 3 business combinations defines a business combination as a transaction or other event in which an acquirer or the parent obtains control over one or more businesses. So there's quite a lot of key concepts in that definition. The one I want to look at now is control, which we'll unpack a little bit later. If you have control over one or more businesses, you have a business combination and you have to follow IFRS 3. IFRS 10 prescribes the accounting treatment of the consolidated financial statements and specifically gives the definition of control. So there's the link between IFRS 3 and IFRS 10. For there to be a business combination, you need control. IFRS 10 gives you the definition of control, which we will look at in a lot of detail a little bit later on. Furthermore, IFRS 3 business combinations focuses on acquisition date, on that day when you gain control over another business, where the one company gains control over the business. What needs to happen on that date specifically? And then IFRS 10 consolidated financial statements prescribes the accounting treatment since acquisition date. So you need to comply with both IFRS 3 and IFRS 10 when you prepare consolidated financial statements. Now, investments in other companies can be in different forms. You can have joint arrangements, you can have an investment in an associate, or an investment in subsidiary. For FRK 201 purposes, we will only look at investments in subsidiaries where the parent company gained control over that subsidiary. There's two videos available that digs a little bit deeper into these definitions, the different forms, the different IFRS standards applicable, which is available in the learning community, which you are more than welcome to have a look at, just to gain a little bit of a deeper understanding of why we have all these different IFRS applicable. Let's think about the following questions. When do we have a group of companies? A group of companies is defined as a parent company with all of its subsidiaries. What is a subsidiary? A subsidiary is a company controlled by another company. So again, key to the identification of a business combination or a group is the control that one entity obtains over another entity. If you read the definition of control, you will see it's quite involved and it's quite a lengthy definition, but it can be broken down into three main concepts. The investee needs power over the relevant activities of the entity. That power can be in the form of having ownership of equity instruments, being able to vote on shareholders' meetings, contractual rights, or being able to hire and fire the majority of the board members. There's power over relevant activities. That power must give the investee or the parent company exposure to variability in returns, and that exposure to returns in the form of dividends or profit sharing or whatever the case might be can be either positive or negative or both. But in addition to having power over this investee and having exposure or rights to variable returns, the final vital element of this definition of control is that there must be a link between these two components of the definition. The investor, the parent, must have the ability to use its power to affect its returns from its involvement with the investee. Without that link, using its power to direct the relevant activities, the benefits that they want to gain from this business combination, there cannot be control. What is then the accounting treatment or the accounting requirement once you have on control? Because you have a business combination, the moment there is control over another business, you have to prepare consolidated financial statements. Key to this is the control of the parent over the subsidiary. Now that we know the importance of the concept of control and the fact that you have to prepare consolidated financial statements when there is control of one company over another, let's think about this question. What do you think is the one key principle that will ensure that we faithfully represent a set of consolidated financial statements? It draws back on the concept of faithful representation from the framework. That numbers, those amounts that you're putting in the consolidated financial statements, needs to be a faithful representation of the group. It's important to establish a principle here. Otherwise, preparing consolidated financial statements becomes a recipe, and that is the last thing we want to do. If we can understand this key principle and apply this key principle to each and every single line item in the consolidated financial statements, we will end up with faithfully represented amounts. This key concept is to prepare the consolidated financial statements as if it's one single economic entity. So I have as a starting point, like I've mentioned before, the separate financial statements of the parent and the separate financial statements of the subsidiary. I now need to start with that, do something to it, so that my result is as if it's no longer two separate sets of financial statements, but one single economic entity. This concept draws from the definition of consolidated financial statements, which is the financial statements of a group in which the assets, liabilities, equity, income, expenses, and cash flows of the parent and its subsidiaries, of the separate entities, are presented as those of a single economic entity. We will refer back to this principle every time we perform consolidation procedures.